Top tax advantages of buying a home. Save money with these tax deductions and credits. Thinking of buying a home? There are plenty of perks if you purchase one. You can decorate it to suit your taste. You can install a professional home theater system, or you can perfectly customize the walk-in closet to hold everything you have just the way you want it. But there are other benefits, the financial kind. If you rented in the past, all of your money went to a landlord, and none of it came back to you as a tax deduction. That changes if you're a homeowner. Whether you buy a mobile home, townhouse, condominium, cooperative apartment, or single-family home, several tax breaks can save you money at tax time. The only downside is that your taxes will get more complicated. Gone are the days when you plug your W-2 information into the 1040s form and finish your taxes 10 minutes later. As a homeowner, you enter the wonderful world of itemizing. Of course, it's worth the hassle when you see how much money you might save. Key takeaways. Buying a home may be the most expensive and important purchase you make in your life. The Internal Revenue Service, IRS, provides several tax breaks to make home ownership more affordable. Common tax deductions include those for mortgage interest, mortgage points, and private mortgage insurance, PIME. To claim the deductions, you have to itemize your taxes and not take the standard deduction. Tax credits are available for qualified first-time home buyers and homeowners who invest in energy improvements, e.g., solar panels and energy-efficient windows. Tax credits vs. tax deductions. In the tax world, there are deductions and there are credits. Credits represent money taken off of your tax bill. Think of them as coupons. If you get a $1,000 tax credit, your tax due will decrease by $1,000. A tax deduction reduces your adjusted gross income, AG, which in turn reduces your tax liability. For example, if you're in the 24s tax bracket, your tax liability will be reduced by 24s of the total claim deduction. So if you claim a $1,000 deduction, you can expect your tax liability to drop by $240, $1,000 x 24. Tax deductions for homeowners. Most of the favorable tax treatment that comes from owning a home is in the form of deductions. Here are the most common deductions. Mortgage interest deduction. You can deduct your home mortgage interest on the first $750,000, $375,000 if married filing separately. Of mortgage debt, the old limit, $1 million, $500,000 if married filing separately, applies if you bought your home before Dec. 16/2017. You can't deduct home mortgage interest unless you itemize deductions on schedule of Form 1040 or 1040. ISR, and the mortgage is a secured debt on a home in which you have an ownership interest. You can deduct mortgage interest on a second home as long as the mortgage satisfies the same requirements for deductible interest as on your primary residence. In January, after the end of the tax year, your lender will send you Internal Revenue Service, IRS, Form 1098 detailing the amount of interest that you paid in the previous year. Be sure to include any interest that you paid as part of your closing. Lenders will include interest for the partial first month of your mortgage as part of your closing. You can find it on the settlement sheet. Ask your lender or mortgage broker to point this out to you. If it's not included on your 1098, add this to your total mortgage interest when doing your taxes. Mortgage points deduction. You may have paid mortgage points to your lender as part of a new loan or refinancing. Each point that you buy generally costs 1, and the total loan and lowers your interest rate by 0.25. For example, if you paid $300,000 for your home, each point would equal $3,000, $300,000 x 1. And with a 4 interest rate, for instance, that 1 point would lower the rate to 3.75 for the life of the loan. As long as you actually gave the lender money for these discount points, you get a deduction. Like the mortgage interest deduction, discount points are deductible on the first $750,000 of debt. If you refinanced your loan or took out a home equity line of credit, HELOC, you receive a deduction for points over the life of the loan. Each time you make a mortgage payment, a small percentage of the points is built into the loan. You can deduct that amount for each month that you made payments. So if $5 of the payment was for points and you made a year's worth of payments, your deductible amount would be $60. Your lender will send you Form 1098 detailing how much you paid in mortgage interest and mortgage points. Using that information, you can claim the deduction on Schedule A of Form 1040 or 1040 or 1040 or 1040. Private mortgage insurance, PME. Lenders charge private mortgage insurance, PME, to borrowers who put down less than 20s on a conventional loan. PMI usually costs $30 to $70 a month for each $100,000 borrowed. Like other types of mortgage insurance, PMI protects the lender, not you. If you stop making mortgage payments, depending on your income and when you bought your home, you might be able to deduct your PMI payments. Mortgage insurance premiums can now no longer be deducted. Prior to 2022, the PMI deduction expired and was renewed several times. The PMI deduction expired in 2017 but was renewed in 2019 and retroactively applied to the 2018 tax year. The deduction was available for 2020 and extended through 2021 under the Consolidated Appropriations Act. As of 2020, for 2022 returns, the ERS has let the deduction expire and taxpayers can currently no longer deduct mortgage insurance premiums. State and local tax, SALT deduction. The state and local tax SALT deduction lets you deduct certain taxes paid to state and local governments, provided that you itemize on your federal return. The $10,000 cap applies whether you are single or married filing jointly and drops to $5,000 if you're married filing separately. The deduction limit relates to the combined total deduction of state income, local income, sales, and property taxes. You must itemize your deductions to claim the mortgage interest deduction, mortgage points deduction, and SALT deduction. You can't claim these deductions if you take the standard deduction when filing your tax return. If you pay your property taxes through a lender escrow account, you'll find the amount on your 1098 form. Alternatively, you will have personal records in the form of a check or automatic transfer if you pay directly to your municipality. Be sure to include payments that you made to the seller for any prepaid real estate taxes. You can find them on your settlement sheet. State and local income taxes withheld from your paycheck appear on your W-2 form, which your employer should send by the end of January following the tax year. If you elect to deduct state and local sales taxes instead of income taxes, you can't deduct both. You can use your actual expenses or the optional sales tax tables found in Schedule AA Form 1040. Home sale exclusion. Chances are you won't have to pay taxes on most of the profit that you might make when you sell your home, thanks to the home sale exclusion. If you've owned and lived in the home for at least 2 of the 5 years before the sale, you won't pay taxes on the first $250,000 of profit. EA capital gain. The number doubles to $500,000 if you're married filing jointly. However, at least one spouse must meet the ownership requirement and both spouses must meet the residency requirement, i.e., lived in the home for 2 out of the previous 5 years. You might be able to meet part of the residency requirement if you had to sell your home early due to a divorce, job change, or something else. If you have a taxable gain on the sale of your main home that's greater than the exclusion, report the entire gain on Form 8949, Sales and Other Dispositions of Capital Assets. Depending on how long you own the home, any gains will be taxed at either the short-term or long-term capital gains rate. Short-term capital gains tax rates apply if you owned the home for less than a year. These gains are taxed at your ordinary income tax rate, which is 10s to 30, 7s for 2022 and 2023. Long-term capital gains tax rates apply if you owned the home for more than a year. The rate is 0, 15, or 20, depending on your filing status and income. Tax credit. You might be eligible for a mortgage credit if you were issued a qualified mortgage credit certificate, MOC, by a state or local governmental unit or agency under a qualified mortgage credit certificate program. Also, check energy.gov to find out whether your state offers tax credits, rebates, and other incentives for energy efficient improvements to your home. Which expenses can itemize? You itemize your deductions on Schedule of Form 1040. Homeowners can generally deduct home mortgage interest, home equity loan or home equity line of credit, HELOC, interest, mortgage points, private mortgage insurance, PI, and state and local tax. Alt deductions. You also may be able to deduct charitable donations, casualty and theft losses, some gambling losses, unreimbursed medical and dental expenses, and long-term care premiums. Who should itemize deductions? You can either take the standard deduction or itemize your deductions. If the value of expenses that you can itemize is greater than the standard deduction, then it makes financial sense to itemize. Also, you must itemize to claim the mortgage interest, mortgage points, and SALT deductions. What are the standard deduction amounts for 2022? For tax year 2022, the standard deduction is $12,950 for single and married filing, separately taxpayers $19,400 for heads of household, and $25,900 for married filing, jointly filers, and surviving spouses. What are the standard deduction amounts for 2023? For tax year 2023, the standard deduction is $13,850 for single of married filing, separately taxpayers, $20,800 for heads of household, and $27,700 for married filing, jointly filers. The bottom line. Let's keep this in perspective. If you're in the 24 tax bracket, you're still paying nearly 75% of your mortgage interest without any deductions. Don't fall into the trap of thinking that paying interest is beneficial because it reduces your taxes. Paying off your home as quickly as possible is by far the best financial move. There's no prepayment penalty for paying off your mortgage, so pay as much as you can if you plan to live in the home for a long time. Of course, talk to your financial planner about the most beneficial way to pay down your debt. Tax breaks for second homeowners. Tax deductions can make owning a second home more affordable. If you're thinking about buying a second home for vacations, rental income, or an eventual retirement residence, it makes financial sense to take advantage of all the available tax breaks. After all, you can significantly reduce the cost of owning a second home by claiming tax deductions for mortgage interest, property taxes, and rental expenses. The Tax Cuts and Jobs Act (TJ) changed how tax breaks work in ways such as reducing the mortgage interest deduction. Still, even with these changes, there are helpful tax breaks that can help make owning a second home more affordable. Here's a quick rundown. Key takeaways. The Tax Cuts and Jobs Act changed the way many tax breaks work. Different rules apply to the mortgage interest deduction depending on whether your second home is considered a personal residence or a rental property. You can deduct interest on home equity loans, but only if you use the funds to buy, build, or substantially improve the home. If the home is considered a rental property, you can deduct costs related to owning and operating the property. Mortgage interest deduction. The mortgage interest deduction has long been praised as a way to make owning a home more affordable. However, the TJ, signed into law in December 2017, changed how much you can save through mortgage interest deductions for both primary residences and second homes. If the second home is considered a personal residence, you must file Form 1040 or 1040. Enter in itemized deductions on Schedule A to claim the mortgage interest deduction. Additionally, the mortgage must be a secured debt on a qualified home in which you have an ownership interest. In most cases, single filers and those married filing jointly can deduct all of their mortgage interest on up to $750,000 of mortgage debt. This rule applies to any personal residence, whether it's your first or second home. The previous limit was $1 million of mortgage debt, which still applies on home loans taken out before Dec. 16, 2017. Different tax rules apply to the mortgage interest deduction depending on whether your second home is considered a personal residence or a rental property. With rentals, the number of days you rent the property, as opposed to living in it yourself, also comes into play. Tax breaks for second homeowner. Mortgage interest deduction. Personal residence. If your second property is considered a personal residence, you can deduct mortgage interest in the same way you would on your primary home, up to $750,000 if you're single or married filing jointly. The limit is $375,000 if you're married and filing separately. To qualify for the deduction, the mortgage must be a secured debt on a qualified home you own, and you must itemize your deductions by filing Schedule AIE. According to the ERs, a home is qualified if it's your main home or a second home. The home can be a house, condominium, cooperative, mobile home, house trailer, boat, or similar property, as long as it has basic living accommodations, e.g., sleeping, cooking, and toilet facilities. The $1 million mortgage interest limit will return in 2025 when the TJ expires unless lawmakers act to keep the law in place. Mortgage interest deduction, rental property. The rules are more complicated if you rent out the property for part or all of the year. What matters is the breakdown between personal and rental use. If the IRS views the home as an investment property, you can't claim the mortgage interest deduction. but you can deduct mortgage interest as a business expense to lower your rental income. Your use of the property will fall into one of three categories. Use often, rent rarely. You don't have to report rental income to the Internal Revenue Service, IRS, if you rent your home for 14 days or fewer during the tax year. The house is considered a personal residence, so you can't deduct rental-related expenses like advertising and utilities. However, you can deduct mortgage interest and property taxes as you would with any home. And when you sell the property, it will be treated as a personal residence, not an investment property. This rule applies even if you rent your home for $10,000 per night. Section 280AG of the Internal Revenue Code says the money doesn't need to be included in your gross income, provided you rented the home for fewer than 15 days per year. Use rarely, rent often. Your home is considered a rental property and not a personal residence if you rent it out for more than 14 days per year. Your use of the home doesn't exceed the greater of 14 days or 10 of the days it's rented. Because the home is considered a business, you can deduct rental expenses, including mortgage interest, property taxes, insurance costs, property manager fees, utilities, and property depreciation. However, you must report any income from the property as rental income, and that income will be taxed as ordinary income according to your tax bracket. It's worth noting that days spent maintaining or fixing the property don't count as personal use days. So it's possible to exceed the 14-day limit if you stay at your property to perform a repair. Plan to document your maintenance activities by retaining receipts to prove you weren't just vacationing on those days. If you use your second home for both personal and rental purposes, you generally must divide your total expenses between personal and rental use based on the number of days you used it for each purpose. Use some, rent some. Your second home is considered a personal residence and not a rental property if you rent it for more than 14 days per year. Use it for more than the greater of 14 days or 10 of the total days the property was rented. This means you can deduct mortgage interest and property taxes as you would with any home. You can deduct rental expenses, but only up to the level of rental income, i.e., you can't claim rental losses. If a member of your family uses the property, including your spouse, siblings, parents, grandparents, children, and grandchildren, those days count as personal days unless you are collecting a fair rental price during those family stays. Home equity loan interest deduction. In addition to the mortgage interest deduction, you may be able to write off interest on a home equity loan. However, the TJ has changed these rules as well. Previously, you could borrow against home equity and take a deduction on the interest, regardless of whether you use the proceeds to pay off a credit card, take a vacation, or buy a second home. Now, you can deduct interest on home equity debt only if you use the funds to buy, build, or substantially improve the taxpayer's home that secures the loan. Under these provisions, if you want to deduct interest on a second home, you must have a mortgage on it. If you borrowed against the equity on your first home to finance the purchase of your second home, you can't deduct the interest. Like a mortgage, you can deduct interest on up to $750,000 in home equity debt if you are single or married filing jointly, $375,000 if married filing separately. The mortgage interest deduction limit applies to all of your mortgage and home equity debt. If you already have $750,000 or more in mortgage debt, you can't claim an interest deduction on home equity loans exceeding that amount. Property tax deduction. You can deduct property taxes on your second home and, for that matter, as many properties as you own. However, the TJ has also brought changes that affect those deductions. You can no longer deduct the entire amount of property taxes you paid on real estate you own. Now, the total of state and local tax, SALT, eligible for a deduction, including property and income tax, is limited to $10,000 per tax return or $5,000 if you're married and filing separately. Many people who buy a second home may already exceed that limit with their first home, so they may not see additional tax savings from their second home. Selling your second home. If you sell your primary residence, you can exclude up to $250,000 in capital gains from your income or up to $500,000 if you're married and file jointly. However, this is for sales of primary residences only. When you sell your second home, you must pay a capital gains tax on your entire profit. Making the second home your primary home could potentially lessen the capital gains hit. To do so, you would need to live in the second property for at least 2 years out of the 5 years before selling it. This would qualify the property as your primary residence. Also, to be eligible for the exclusion, you must not have taken the capital gains exclusion on the sale of another home during the previous 2 years. 1030. 1 exchanges. If you hold a second property for business or investment purposes, you might be able to defer capital gains taxes under a 1030. 1 exchange. Known as a like-kind exchange, this involves selling the property and replacing it with a similar property. Both properties must be located in the U.S. When you sell the initial property, you must identify a replacement property within 45 days and acquire it within 180 days. Capital gains are then deferred until the replacement property is sold, although it is possible to continually defer taxes with further like-kind exchanges. You must meet several conditions to qualify for a like-kind exchange. You must own the property for at least 2 years before selling. In each of the 2 12-month periods before the sale, you must have rented the property for at least 14 days. Your personal use of the property can't exceed the greater of 14 days or 10 of the days the home was rented. The replacement property must also meet these same conditions. It must be held for at least 2 years after the like-kind exchange. It must be rented for at least 14 days per year. The period used for personal enjoyment cannot exceed the greater of 14 days or 10 of the days the home was rented. Because tax laws are complicated and change periodically, it's advisable to consult with a qualified real estate tax specialist who can explain relevant tax implications and laws and help you determine the most favorable ownership strategy for your situation. Is rental income taxed as ordinary income? Maybe. If you rent out your home for more than 14 days during the year, you must report the revenue on your tax return, and the net income is taxable as ordinary income. If you rent out your home for 14 or fewer days, you do not have to report or pay taxes on the income. What happens if you don't report rental income? If you rent out your home for more than 14 days, you must report the income on your taxes. If you're required to report the income, and you don't, you'll be committing tax fraud, which can lead to fines and even jail time. The IRS can discover unreported rental income through tax audits triggered by random selection, computer screening, records matching, and third-party reporting. Are second home expenses tax deductible? Yes, but it depends on how you use the home. If the home counts as a personal residence, you can generally deduct your mortgage interest on loans up to $750,000, as well as up to $10,000 in state and local taxes, SALT. If the home is considered an investment property, according to IRS rules, you can deduct expenses related to owning, maintaining, and operating the property. Is home equity loan interest tax deductible? If you use the funds to pay for, say, a vacation or college, you can't deduct the interest. The bottom line: if it's financially feasible, owning a second home can be an excellent investment for vacation or rental purposes, and it could also provide a suitable primary home during retirement. Still, owning any home carries a significant financial burden, from mortgage and taxes to maintenance and repairs. It's in your best interest to learn the tax implications for second home ownership before jumping in, and work with an experienced tax specialist if you need clarification or guidance. Rental property tax deduction. Take advantage of these money-saving tax breaks. Do you own real estate that you rent out? Besides the potential for regular income and capital growth, real estate investments offer deductions that can reduce the income tax on your profits. But first, consider what kind of real estate investor you are. Are you a passive investor or a real estate professional? Your classification as one or the other determines how your income and losses are treated. Key takeaways: rental property owners can deduct the costs of owning, maintaining, and operating the property. Most residential rental property is depreciated at a rate of 3.636 per year for 27.5 years. What the IRS considers the property's useful life. Only the value of the buildings can be depreciated. You can't depreciate the land since it never gets used up. The tax treatment of income and losses depends on your level of involvement in the rental property. Tax treatment of income and losses. Real estate is generally considered a passive activity. However, your level of participation determines the tax treatment of the income and losses the property generates. Real estate professionals. The Internal Revenue Service, IRS, defines a real estate professional as someone who spends more than half of their working hours in the rental business. This may include property development, construction, acquisition, and management. You must also devote more than 750 hours per year to working on your real estate rental properties to qualify as a professional. Activities of real estate professionals are not treated as passive activities. Instead, the income you generate is characterized as active income, i.e., non-passive income, i.e., non-passive income. As such, you can use losses to offset other income, e.g., wages, salaries, interest, and dividends, and avoid the 3.80 net investment tax if the rental generates income. Material participation. If you materially participated as a real estate professional, your rental property involvement will receive non-passive tax treatment. You can use any losses to offset other types of income, and you won't be subject to the net investment tax. According to the IRS, you materially participated in an activity if you satisfy any of the following tests. You participated in the activity for more than 500 hours during the year. You do all or nearly all of the work in the activity. You work 100 hours in the activity during the year and work at least as much as anyone else. The activity is a significant participation activity SPA, and you participated for at least 500 hours in SPA. You materially participated in the activity for any 5 of the previous 10 years, whether consecutive or not. The activity is a personal service activity, and you materially participated for any 3 preceding tax years. Based on all the facts and circumstances, you participated in the activity on a regular, continuous, and substantial basis during the year. Active participation. Active participation is a lower standard of involvement than material participation. The IRS treats you as actively participating if you make management decisions in a significant and bona fide sense. Management decisions that count as active participation include things like approving new tenants, determining rental terms, approving expenditures. If you actively participate by making management decisions and have at least a 10 interest in the investment, you might be able to deduct some of your passive losses. This level of participation allows a special passive loss rule. In general, you can deduct up to $25,000 of passive losses if your modified adjusted gross income, MAGI, is $100,000 or less. The deduction phases out if your MAGI is between $100,000 and $150,000. Once your MAGI exceeds $150,000, you can't take any passive losses. Losses of more than $25,000 can be carried over to the following year. Passive activity. On the other hand, if your rental property is a sideline investment and you don't materially participate in the investment, it's considered a passive activity. In this case, any passive activity losses can be used only to offset passive activity income. In other words, you can't use any losses from the rental property to shelter other taxable income. Instead, the losses are carried forward until you generate passive income or sell the investment. Rental property income sources. If you own rental property, you have to report all of the rental income you receive. But keep in mind that includes more than just those monthly rent checks. Rent. The money you receive for rent is generally considered taxable in the year you receive it, not when it was due or earned. This means any advance payments must also be treated as income. For example, suppose you rent out a house for $1,000 per month and you require new tenants to pay the first and last month's rent when they sign a lease. In this case, you'll have to declare the $2,000 you received as income, even though $1,000 of that $2,000 covers a period that might be several years in the future. Tenant. Pay expenses. Expenses your tenants pay count as rental income if the expense is for something they're not obligated to pay. For example, suppose your tenant pays the water bill and deducts it from their regular rent payment. In that case, you must include the amount in your rental income. Depending on the expense, you may then deduct the amount as a rental expense. Trade for services. If your tenant offers to trade services in exchange for rent, you must include the fair market value of the services as income. For example, if your tenant paints the rental house in exchange for 1 month's rent, valued at $1,000, you must include the $1,000 as income even though you didn't receive the cash. However, you will be able to deduct the $1,000 as an expense. Security deposit. Security deposits are not taxable when you receive them if the intent is to return the money to the tenant at the end of the lease. But what if your tenant does not live up to the lease terms? For example, suppose you collect a $500 security deposit and your tenant moves out and leaves holes in the walls that cost $500 to repair. You must include the $500 as income for that year. but you can also deduct the repair cost. Note that a security deposit used as a final rent payment is considered advance rent. Hence, you include it as income the year you receive it. Rental property tax deductions. As a rental property owner, you can deduct various expenses related to buying, operating, and maintaining the property. Here's a rundown of the most common deductions. Mortgage interest deduction. Expenses to obtain a mortgage, such as commissions and appraisal fees, are not deductible when you pay them. Instead, these costs are added to your basis in the property. Still, you can deduct interest on up to $750,000, $1 million if you took out the mortgage before DEC 16/2017 of secured mortgage debt on your first or second home. For investment properties, you can deduct mortgage interest as a business expense. Your mortgage company will send you an IRS Form 1098 each year showing how much you've paid in interest throughout the year. If part of your payment includes money that goes into an escrow account to cover taxes and insurance, your mortgage company should report that to you as well. While home mortgage interest is reported on Schedule A of the 1040 or 1040 sister tax form, rental property mortgage interest is reported on Schedule E. The Tax Cuts and Jobs Act (TJ), passed in 2017, reduced the maximum mortgage principal eligible for the deductible interest to $750,000 from $1 million for new loan. The TJ also nearly doubled the standard deduction, making it unnecessary for many taxpayers to itemize. Rental property depreciation. Another key tax deduction is the allowance for depreciation. Rather than taking one large deduction when you buy or improve a property, depreciation lets you deduct the costs over the property's useful life. The IRS lets you depreciate a rental property if it meets these requirements. You own the property. You use the property in your business or income producing activity. The property has a determinable useful life, meaning it's something that wears out, decays, gets used up, becomes obsolete, or loses its value from natural causes. You expect the property to last for more than 1 year. The property was not placed in service and later disposed of or no longer used for business during the same year. Land is not depreciable since it never gets used up. Likewise, you generally can't depreciate the costs of clearing, planting, and landscaping since those activities are considered part of the cost of the land, not the buildings. Residential rental property placed in service after 1986 is depreciated using the Modified Accelerated Cost Recovery System, ACRS. This method spreads costs and depreciation deductions over 27.5 years, what the IRS considers the useful life of a rental property. While depreciation saves you money now, the IRS might want some of that money back. If you depreciate property and then sell it for more than its depreciated value, you'll owe depreciation recapture taxes on the gain. Many real estate investors use 1031 exchanges to defer taxes, including depreciation recapture and capital gains taxes. Repairs and improvements. Rental property owners may assume that anything they do on their property is a deductible expense. Not so, according to the IRS. A repair keeps your rental property in good condition and is a deductible expense in the year when you pay for it. Repairs include painting, fixing a broken toilet, and replacing a faulty light switch. On the other hand, improvements add value to your property and are not deductible when you pay for them. Instead, you recover the cost of improving and buying a property by depreciating the expense over your property's useful life. Improvements might include a new roof, patio, or garage. From a tax standpoint, you should make repairs as problems arise instead of waiting until they multiply and require renovations. Property taxes. Property taxes are an ongoing expense for rental property owners. Homeowners can deduct up to a total of $10,000, $5,000 if married filing separately, for property taxes and either state and local income taxes or sales taxes. However, that limit doesn't apply to business activities. Depending on your level of participation in the property, you may be able to deduct the full amount as a business expense. Travel expenses. Money you spend on travel to collect rent or maintain your rental property is deductible. However, if the purpose of the trip was for improvements, you must recover that expense as part of the improvement. There are two ways to deduct travel expenses, using the actual expenses or the standard mileage rate. The latest details about the IRS's requirements and current mileage allowance are in IRS Publication 463. Other common expenses. In addition to mortgage interest, repairs, and depreciation, some other common expenses you can deduct include advertising, home office expenses, insurance premiums, lawn care, losses from casualties, hurricane, earthquake, flood, etc., or thefts, professional services, e.g., accountants, tax preparers, property managers, attorneys, utilities, the cost of personal property, e.g., appliances and furniture used in rental activity, condominiums, and cooperatives. If you own a rental condominium or cooperative, each has some special rules. Condominiums. If the rental is a condominium, you probably pay dues or assessments to maintain common areas, such as lobbies, elevators, and recreational areas. When you rent out your condominium, you can deduct expenses, such as depreciation, repairs, interest, and taxes that relate to this common property. However, just as with a single-family rental, you can't deduct money spent on capital improvements, such as an assessment for a cabana at the clubhouse. Instead, you must depreciate your share of the cost. Cooperatives. Expenses for a cooperative apartment you rent out are deductible. This includes the maintenance fees paid to the Cooperative Housing Corporation. Capital improvements are treated differently. You can't deduct improvement costs, nor can you depreciate them. Instead, you must add the cost of the improvement to your cost basis in the corporation's stock, reducing your capital gain when you sell. Record keeping. Under the ERS's Schedule E, there are spaces for miscellaneous categories of expenses. That gives you flexibility in the items that you can deduct. But be prepared to back up your claim and separate costs for repairs and maintenance from those that are capital improvement. Remember, the money you spend on improvements could reduce your tax liability when you sell. Plan to keep supporting documentation like appointment books, diaries, calendars, and logs to prove your active participation and the time spent on your properties each year. Where do I report rental income? You report rental property income, expenses, and depreciation on Schedule E of your 1040 or 1040E or 1040 SEER U.S. tax return for seniors. You'll have to use more than one copy of Schedule E if you have more than 3 rental properties. What deductions can I claim for rental property? As a rental property owner, you can claim deductions to offset rental income and lower taxes. Broadly, you can deduct qualified rental expenses, EAEBU, mortgage interest, property taxes, interest, and utilities, operating expenses, and repair costs. You can also depreciate the cost of buying and improving the property over its useful life, generally 27.5 years. You may also be able to deduct an additional 20s of your qualified business income, QBE. However, to qualify for the QB deduction, the rental real estate must rise to the level of a trade or business under Section 162 of the Internal Revenue Code, among other restrictions. What is a 1031 exchange? When you eventually sell your rental property, you could be on the hook for capital gains and depreciation recapture taxes. Many real estate investors defer these taxes by using a 1031 exchange, which lets you swap one investment property for another. According to the ERS, the exchange properties must be like kind, meaning they're of the same nature or character, even if they differ in grade or quality. Is rental income taxed as ordinary income? Maybe. If you rent out a property for more than 14 days during the year, you must report the rental income on your tax return, and the net income is taxable as ordinary income. You don't have to report or pay taxes on the income if you rent out the property for 14 or fewer days. The bottom line. Rental property ownership tends to be most profitable when you consider the tax rules before jumping in. Since there are quite a few deductions available, it pays to know which ones you qualify for so you can maximize your bottom line. Moreover, it's essential to understand how taxes work on your rental income and the eventual sale of your property. For more guidance and help with deductions, taxes, and planning, be sure to consult a qualified tax professional. Article sources.